The decision about what to invest in is an ancient one. In ancient Rome, they didn't have stock markets. Wealthy Romans would invest their money into physical assets like commodities, gold or silver, or wheat, or slaves, or real estate, and they would carry their money around in big chests. Case in point, Marcus Crassus, the wealthiest Roman to ever live, was worth about 50 million denarius, or in today's money, around $167 million. He invested largely in real estate, but he didn't have the option of stocks. Stocks nowadays is another way to invest your money, and arguably much higher merited. Part of the goal here is to carefully deconstruct the idea that property is a fantastic investment. Let's start with the returns. Now, this can be difficult because it depends on which time period you're looking at and also which country, which metrics. But giving you some examples from the US and the UK. So, the UK property market in the 10 years to 2023 grew by about 6.5% a year. And in the last 25 years up to 2024 in the US, the property market grew by about 5.7% a year. Now, if we compare that to the market, let's say the S&P 500, in the 10 years to 2023, the S&P 500 grew by 15% a year. And in 25 years in that period, it was about 10% a year. So, purely on the basis of return, the stock market wipes the floor with the property market. To put it into context, in the UK, let's say you invested £170,000 into property in 2013. That would be worth about $286,000 in 2023. Over the same period, if you invested $170,000 into the market, i.e. the S&P 500, that would have grown to £630,000. That's a massive difference in capital gain. Now you might say to me, yes, but my property produces rental income. Well, it is true to say that the figures I've given for the S&P 500 include the reinvestment of dividends, bearing in mind that shares do give you income in the form of dividends. They pay you a part of the profits for being a shareholder. But even if we take those away and assume they're paid to you, that's money that you've had, the S&P 500 return is about 6.5% a year. So about the same as UK property growth and higher than US property growth. But here's the thing. Those dividends that are paid to you in full with virtually no costs. You can own a mutual fund with almost no cost at all. Whereas if you own a property and you get a rental income, quite often landlords will find that costs eat all of it up. And they might have mortgage payments, debt interest payments. And they might have, here's an example. The stock market doesn't call you at 4 a.m. because the toilet's broken. You have to fix everything in the property. You have to fix the boiler if it's broken. You have to pay insurances. You have to pay for redecoration at times. And the costs for getting into a property are absolutely massive. Lawyers' fees, estate agents' fees, and when you sell it. And that's before we come to tax. Because frankly, again, the stock market wipes the floor with the property market when it comes to tax. But let's first of all talk about hassle. You own a property and you don't know what the tenants are like. Sometimes you'll have void periods where there's no tenants or the tenants won't pay you. In addition to that, you might have to pay fees to a property management company if you don't want to do it yourself. They'll charge you maybe 10% of your rent. None of that applies when you invest in the stock market. You don't have to do anything because you have a company running itself, run by people who, for the most part, know how to run it, especially in big indices like the S&P 500. You've got a company managing it with no involvement from you in order to grow the company and generate profits versus you yourself managing a property. The hassle, therefore, is absolutely through the roof when it comes to property investment and virtually no hassle in a stock market investment. The next big point is tax. Because stocks are more favourably taxed than property is. If you buy a property, a second property in the UK, you will pay the normal level of stamp duty plus a flat 3% on top against the value of the property. Now, when you buy shares, if it's a fund, a mutual fund, there won't be any stamp duty for a start. The second thing is that over time, either a stock investment or a property investment, as we know, will grow. And that growth is called the gain. Now, within a stock investment, you can sell stocks and rebuy on an annual basis to use up your capital gains tax exemption, which unfortunately has now fallen to £3,000. But it is still there, a use it or you lose it allowance. So if you sell up to £3,000 of gain in your portfolio every year, you can wash out some of the gains or all of the gains if the portfolio is a small enough one. That's because it's a highly liquid market. You can sell stocks, rebuy, or if you want to buy the same stocks again, sell them, wait 30 days and rebuy them. That will wash out the gain. That's known as a bed and breakfast exercise. You cannot do that with a property. There are lots of people with huge property portfolios utterly impregnated with gains. They can't do anything about it unless they sell the whole property and take a big hit on capital gains tax. Because you can't sell half a property. But like you're seeing in the newspaper, there's 50% of a property for sale. Nobody's going to buy that. So you can't do the same thing with property. The other thing is the income. Rental income is just subject to income tax. And income tax rates are 20%, 40% or 45%. Whereas dividend tax, so the tax on the income from your shares, is a much lower rate. 8.75% at the basic rate, circa 33% and then 38% at the additional rate. So much less tax is paid in the stock market than the property market. Just to add to that about liquidity. Liquidity is important. With the stock market, it's highly liquid. You can get money whenever you like. If you've got a property, it might take you 3 to 6 months to sell it. Your money is locked in for a long period in an illiquid asset that you can't realise quickly in an emergency. Now, on top of all of that, you can use tax shelters for your stocks and shares. You can have a stocks and shares ISA, which you're funding $20,000 a year into, gradually building up a pot of stocks which are free from all tax. But you can't put a property into an ISA, nor can you put a property into a pension. You can put commercial property into a particular type of pension, a SIP, but it's highly complicated and you can't use residential property in a SIP. So even though taxes are better in a general investment, which is taxable, you can use tax shelters to further reduce the tax. Okay, but what about this? Volatility. That's often cited as one of the cons of the stock market. Prices are traded daily. You can see exactly what the market's doing. It's going up and down. And companies can go bust. Whereas if you have a property, unless we find ourselves in the Blitz again, you're going to keep having a property. Well, to answer that, I'd first say this. The reason that property looks less volatile is because they trade less often. A house might be sold every 10 years, so we're not seeing the updated value all the time like we are in the stock market. But the second thing is this. Yes, if you invest in one company, you can lose all of your money. But that's not how modern investors invest. The S&P 500, by definition, is 500 companies. So you're well diversified from the risk of any one company going bust. So that argument doesn't really work either. And let's bear in mind that property can fall in value. You're vulnerable to wherever the property is. If, for example, you have a property in Aberdeen at the moment, then good luck. Because Aberdeen was a thriving oil industry city for decades. With the fall of the oil industry, properties that can't sell there now. Similar to the US with Detroit, which had a thriving car manufacturing industry. After the loss of that industry and the general decline of the city, property prices fell. So you are vulnerable to drops in property price. So with all of that said, should you invest in property? Well, actually, yes. And the reason that you should is because it's diversification. However, you don't have to buy a physical property to do that. There are property funds available that you can buy into. For example, you can buy shares in a company that buys properties, a property oik, effectively. And that means that professionals that know exactly what they're doing in real estate, like a real estate investment trust as well, as an example, will buy properties and generate returns for you. And that's a much simpler way to do it, because therefore you don't have to worry about all of the tax disadvantages and the nightmare calls and all of the things that go with owning the property yourself. But if you have an investment portfolio, you want to have a mix of assets typically. You want to have some shares and some bonds and some property exposure, because diversification overall can actually enhance your returns. Property and stocks are not particularly well correlated. Often when one goes up, the other goes down, so you can have a smoother journey by having both. Is there a case for direct property investment? Well, if you're really good at it. If you're really good at finding a property and managing it and arbitraging, finding the right prices, and you can deal with the tax and you're not worried about that, then you can have a strong property portfolio. But for the average investor who doesn't want hassle and who wants pretty decent returns, because frankly they're going to be better than most property managers achieve, go for a fund or go for the stock market. Go for a diverse selection of funds with some property exposure via those funds. If you've got any comments or you'd like to challenge me, please do so in the comments below. And if you like this video, please do subscribe. Thank you.